in almost the next 75 minutes. So stay tuned. And on this note, can I call on stage Mr. Rajeev Agrawal, founder and CEO at Innoviti Payment Solutions?
Can you just check the mic? Can you hear me? I'll just check the... Can you check the clicker? Okay, tell me when to start. So very good evening to all of you. We have an interesting topic here, payments, profit from it. I believe over the past couple of days, people have been saying there is no money in payments. So I thought it will be interesting to take a contrarian view and show you where money is. So hopefully you'll enjoy this, and happy to take any questions if we have at the end of it. So let me start with a disclaimer on what this talk is not about. It's talking about profits from customers, not investors. Okay, I have no understanding about that. We're talking about how you can make money from customers through genuine value addition, where eventually, hopefully, your cost is less than the revenue and it translates into profits. So very quickly, what does Innoviti do? So we are a company which is actually helping businesses reduce their cost of acquisition by partnering with other businesses in creating purchase tools which can help them to get customers to convert faster and at a better ROI than possible otherwise. I'm just going to take 2-3 slides and jump right into the topic that's of a discussion here. Quickly about us, we process about 60,000 crores of GTV, roughly about 9 lakhs per point of purchase, which is about 2x of India's average. We have the highest weekly average users in the country at greater than 85%. The industry average is about 40% across 3 months. 70% enterprise market share. Net negative churn. We don't lose customers. We don't like to lose customers. And of course, we are operating-wise profitable. Quick snapshot of kind of customers we have. But let's get into our topic. So we're going to talk about 3 things. Firstly, where do profits lie in payments? Where are the profits there? Secondly, if we know where the profits are, how do we tap them? And thirdly, what are the kind of capabilities that are required in order to extract these profits out? There's definitely money in payments, but let's try to understand, break the problem down into parts and see how we go from there. So let me start with a quick snapshot on what the whole digital payment rails in India looks like. So Indian consumption is roughly about $1.6 trillion in FY22. What you will interestingly see is that the digital portion is just about 500 billion. The rest of 1.1 trillion is actually cash. India is still predominantly a cash economy. If you take that the 500 billion, it breaks up into offline and online roughly half. But here is an interesting thing. If you take a view 4 years out, and you would tend to believe, if you were to think about the kind of projections many people talk about, that the whole world should become online. But that's not the case, because digital payments in online are already saturated. There's no cash in online. Online is fully digital. So the growth in digital payments that's happening is all happening in offline. The cash portion that you see here of 1.1 trillion, that's the one which is converting into increased volumes. The normal online is already 100% penetrated digitally, and it's only growing from the perspective of its natural growth. Very contrarian thing, but it is important to understand. There is no cash in online. Online is already digital, but offline has cash. So anyway, broadly, let's look at it. So it becomes, say, about a $1 trillion market by 25, broken up into offline, about 600, and into online, about 400. That's a kind of market. So let's start getting into this interesting topic of making money from payments. So in fintech, you hear of lots of companies. They're talking about 1,000 crore revenues, 2,000 crore revenues, $500 million revenues, and then 2,000 crores of losses, 500 crores of losses. Because in fintech, showing revenue is easy, profit is hard. And let me try to explain why that is the case. So you take payments, and you have this interesting concept of bank MDR. So banks charge MDR. Revenue is roughly about 1%, and your gross margin there is roughly about 10% for the bank. And then you have aggregators. What are aggregators? They combine lots of payment options and create another payment option. Let's call them Bank MDR Plus. So they charge a little bit more, and suddenly the margin drops down to 5%. And then you have super aggregators. A lot of new startups who have got formed who are saying, we are great value adders. We are going to, give you some tremendous experiences by combining together lots of payment options. And they further increase that, and the margin drops further. If you see the net margin here, moved from 10 basis points to 5 basis points to 2 basis points. But the revenue that they're showing is the 1.07%. And that's the 1,000 crores and 2,000 crores and 3,000 crore of revenue. And then obviously the total profit you're generating from there is 2 crores. And that is just not sufficient for you to even pay salaries. Forget creating even a business out of that. So that's the first problem when you look at payments. But then everybody has this very famous story about saying, oh, payments has nothing to do. It's all about lending. And there are, I think maybe about 500 companies, fintech companies talking about lending. Let's build a lending layer on top of this and do lots of stuff. So let's look at lending. Where is the money there? What's the bank's ROI? I'm being generous to the banks. Blended ROIs are not that much. They're about 10 to 11%. But let's say revenue is 15%. Fantastic gross margin because your cost of funds is about 6%, 7%. So you have gross margins of 50%. Then you have a bank ROI plus, a fintech lender, as they call it, right? A guy who is going to take a loan line from a bank and go ahead and distribute it out to customers. His revenue becomes 17%, and suddenly the gross margin has dropped to 10% because 15% he has to pay out. And then he carries a risk of 20%. What's this risk? What is called as the popular FLDG, the first loss default guarantee, in order to be able to make sure that the bank is ready to work with you. And then you have a loan distributor. We had some very interesting business models coming up over the past few years, called loan distributors, who were adding even further value on top of that, where the revenue goes to 18% and the gross margin further drops to 5%. So the problem in this space has been that people have piled on revenue by what we can call it as topping up, or you can call it as just aggregating the revenues from multiple layers to create massive top lines, 2,000 crores, 4,000 crores, 5,000 crores. But the bottom lines are missing. With the exception of one or two companies in the country, virtually no other company is able to post profits. So what's happening here? What is really going inside this? Why is this so challenging in India? So let's take just a minute to understand the fundamentals of payments, the fundamentals of commerce. And I think that will set the stage for where the value lies. So if you look at commerce, commerce is all about a company, a manufacturer creating products. It could be a soap, a mobile, a pin. Maybe somebody is providing surgery as a service. Somebody is providing a dress. And there are trade channels through which the products reach the consumer. And the payment channel is the reverse of that. There are different kinds of payment channel the banks provide, whether it is an IMPS, cards, UPI, what have you, all kinds of interesting payment channels which move the money from the consumer back into the trade channel. So that's fundamentals of commerce, right? I think all of us know that. I'm just leaving this view here for you to relate to orange being payments and purple being trade. So let's look at the conventional payments model. Now, the conventional payments model is all about moving money. Payments means move money from a buyer to a seller. What are the kind of services? So you provide payments acceptance infrastructure. You go ahead and provide aggregation of payment options. You say, look, I'm an aggregator. I can do UPI and I can do cards and I can do so on and so forth. And you provide lots of MIS and reports. And what does this lead to? ultra low margin. It's very low tech stuff, so there are no entry barriers. There are probably in this floor itself about 50 companies who can claim this right now. And heavily funded. This area is heavily funded by VCs and private equity players and leads to what? Therefore, heavy commoditization. Everybody is out there to discount the next guy to be able to make an entry into this and create potentially a market which, like I showed you earlier, was still 2 basis points. But why? Why is it that it is so difficult to make money from this conventional model? This conventional model, incidentally, is a Western model. This is the model which got created in the United States of America. It was copied a lot in Europe. It has translated to Australia. This is the model around which primarily payment businesses move in the world. There are companies like Toast, which are multi-billion-dollar companies generating cash profits of $500 million every year. There are companies like Square, which are generating huge amounts of cash profit every year. Visa, which is generating huge amounts of cash profit. They've been built on this model, exactly on this model. And the core difference there is this. The Western model, the Western economy is in an efficiency mode. The Western economy, the growth in the economy has been stagnant for well over 2 decades. All the changes that are happening in the Western world are happening around efficiency. Technology is being used to drive efficiency. Whether you are at a retail counter, whether you are checking into a hotel, whether you are boarding a train, anywhere it is all about efficiency. India is in a growth phase. India is in a phase where there is tremendous aspiration. There is an unbottled fueling of wanting to do more. And therefore, it's in a growth phase. In a growth phase, efficiency solutions don't make sense. And that's what is happening. If you just take the Western models and apply it to India, that's not going to work. Because those models were created for an economy which is in efficiency mode. India is in a growth mode. That economy is growing at best at 1%, maybe if they're very, very happy at 1.2%. We are growing at 7%, wanting to grow at 10%. It's very, very different. So let's start looking at where the money is. And this is what our personal belief is, that if you move from payments to purchase, you suddenly start seeing value. So what does this mean? What does this mean to move from payments to purchase? Payments is all about moving money from a buyer to a seller. Purchase is peeping behind the payments. You try to see, why did the payment happen? Whenever you go to a shop or you go online and buy something, there is a purpose. There's a story behind what you're trying to do. And that's the purchase. And that's the interesting space. The space when the trade and the payment channels start interacting with each other. You don't take them isolated, you start interaction. Look at the interactions. And what does it create? It creates tremendous opportunities. First, opportunities of managing mismatches, and I'll talk about that. Secondly, opportunities of enabling measurements. And thirdly, opportunities of creating collaboration. Lots of opportunities open up as soon as you start looking at trade and payments together. Don't look at payments in isolation, the Western model. Start looking at them together. What do you create? You create multi-layer earning. You're not earning from just a single source, but multiple layers of sources. You create very sophisticated tech that's not easy to copy for somebody else. So you have massive entry barriers. And you create very, very increased kind of interest that you are seeing in the venture capital and private equity community, who have burned their fingers and hands and all other parts of the body in trying to fund all Western models, and suddenly figured out that they have only wasted thousands of crores out there to large profit pools. So let's try to understand, what does this thing mean? What does this mean managing mismatches? What does it mean enabling measurements? What does it mean to enable collaboration? So first kind of a mismatch is what I call as a mismatch in time. What's a mismatch in time? We often, of course, call it in many other ways, but it is simple, that the time at which the goods exchange hands is not the time at which the payment exchanges hand. Very simple. When the goods exchange hands is not the time when the payment exchanges hand. I'm sure all of you have probably seen this in your own local neighborhood, that you buy medicines from a common pharmacy shop, and every time you buy medicine, the guy in his little khata, he keeps writing it, and at the end of the month, he takes it. So there's a gap. The goods come now, the payments come later. What are the benefits here? It's sales growth with risk. Of course, there's a very popular concept of BNPL, buy now, pay later, or EMIs. All of this fall into that space. That's a space where you can make money, definitely, 30 to 40 basis points. There's an interesting space where you pay now and the goods come later. And many of you might have seen this also. So for example, this is very common in the jewelry segment where they have these schemes where you keep on giving, say, 1,000 rupees every month. And after 11 months, you can buy something for 12,000 rupees. The payments come in advance and the goods come later, right? Again, it is something which is built around payments. What are the benefits here? Is assurance-driven sales growth. The fact that you are already paying upfront means that there is a sale that's going to happen later. So for the merchant, it's great. And these are extremely, extremely profitable businesses. Gift cards fall into that category. Prepaid cards fall into that category, right? A lot of Forex cards fall into that category. All those kind of instruments where you pay first and the services come later come into that kind of a category. This is mismatch in time, when the goods and the service don't match. The second is a mismatch in amount. This is again a very interesting kind of a mismatch. So for example, the very common thing that is there is when the bill amount is equal to the payment amount. That is, you go to a shop, you buy something, and when you buy something, you pay for it, and therefore the bill amount and the payment amount are exactly equal. And this is what is commonly called as transactional reconciliation. You are reconciling at a transaction level, and there's money to be made there. But here is another kind, when the bill amount is not equal to payment amount. And you will see this again in the example that I was giving. Your local kirana guy. In India, it's a very, very popular thing, the khata that the local kirana guy maintains, right? You keep buying, and the person keeps adding, and once in a while you pay some amount. So you may have accumulated for 3,500 and you just pay 2,000. And then you again keep accumulating and then you pay again some more amount. So the sum of customer purchases over time are equal to sum of customer collections over time. But they never actually match. And this is called relational reconciliation. Interestingly, this is a reconciliation which is required in B2B payments. If any of you are entering into B2B payments, it's all relational reconciliation. It's not transactional reconciliation. And that's why one of the reasons why most B2C payment companies have miserably failed in B2B. Because B2C starts from transactional reconciliation, and B2B is all relational reconciliation, right? Lots of money to be made there. These are very complex areas. Very, very complex amount of ledger management that need to be done. But that's a great area of payments. Enabling measurement. So one of the very fine points of payment is that ultimately whatever business initiative that you may take from a sales perspective, any company, whether you are a grocer, whether you are a fashion guy, whether you are a healthcare provider, whosoever you be, ultimately any initiative that you take towards sales will eventually land up in a payment. Because if that initiative is not translating into sale, which means money, what's the point of that initiative? It was just intent. So all your marketing initiatives have to finally consummate into the flow of money. And therefore, if you look at any marketing campaign, and obviously businesses keep running lots of marketing campaigns, lots of promotional tools they will try to build into place, coupons, cashback, loyalty points, etc., and they give it off to consumers. And then consumers come and purchase. Consumers also will use and redeem that particular token out there. And if that payment can be used to attribute the marketing campaign, because the point of payment is when finally the transaction happened. Finally, I can relate to saying that this marketing campaign led to a sale. So if you can use payments for attribution, right? And attribution is one of the most complex area of marketing management for which marketeers will pay you like anything. Because the biggest worry for a marketeer is, I spend a lot of money and I have no way to figure out whether it translated into business, right? So if you can go ahead and use it for attribution, you can prevent fraud, close the marketing loop, and get a real-time visibility into how that business is progressing. And again, there's a lot of money lying inside this. This is a highly underserved area. Nobody really looks at using payment channels for the purpose of attribution. Finally, creating collaboration. So you have multiple parties, right? You have, when as a consumer you go to a shop and buy something, you may think that you are only taking a decision of paying to the merchant, but actually behind the decision there are multiple things happening. You are making a choice of which merchant to go to. Should I go to shop A or shop B? You are making a choice of what goods to buy. Do I buy a Britannia bread or do I buy a modern bread? You are making a choice of how do I wish to pay. Should I pay through an HDFC card or should I pay through a Google Pay? You are making choices. All these parties are talking to the same consumer, but they have no easy way to talk to each other. And that's the third area where payments brings them together. Because ultimately, all their marketing programs come together at the point of payment. And again, a lot of money to be made. So, having done this, let's start looking at, what can you do to tap into this world? So I'm sure, in this crowd out here, there are probably many aspiring new fintechs who are there, many who are already probably running companies and raising their next round of funds, or probably running companies and trying to figure out how do I match the unit economics. It's important to understand revenue is decided by your customer, at least cost is decided by you. So going through those things, how do you tap into this? How do I finally make money out of this? The first piece, in my belief, is develop software for banks. Okay? It's a very, very important area. Develop software for banks. And there are very large, successful companies that have been created in India which have done that. They are licensing SaaS models, highly profitable. It's a very technology and sales-led growth. So you need massive sales teams, enterprise sales teams who are going, tapping at the doors of the banks, convincing them to go ahead and take up your services. You don't get any limelight. Your name will not come on the front page of Economic Times. Okay? Your name is not going to come in Startup Street or whatever is that show on CNBC TV 18 at 10 o'clock in the night. Okay? But yes, definitely you will make profits. Definitely you'll get great outcomes. Okay? You'll definitely make money for yourself. And unfortunately, there are less than 10% fintechs in this space. I was just roaming around here, and there are probably only 4 fintechs in this entire hall which qualify into this space, unfortunately. The second, distributing banks' products. So you are a bank prepares lots of products. There are insurance products, there are loan products, there are mutual funds. There's so many products being created. So you acquire customers for bank. I personally find this as a ridiculous business, simply because it's highly commoditized. Why do you think that you have great digital marketing capabilities which nobody else has? The same set of big ad tech tools are available to you as to your competitor, right? So you can spend lots of money on IPL, you can spend lots of money on the television, you can create lots and lots of noise out there. Absolute junk business, in my view. This is all marketing-led growth. So all you're doing is, you are marketing on behalf of the banks. The banks are, of course, happy because they'll pay you when you get them a customer. So you'll make them more profitable, and obviously you'll increase your losses. Lots of limelight. You will be on the front page of Economic Times. Lots and lots of revenue you can show up because, of course, you will pile up revenue. Lots and lots you can show up. Very, very little possibility of driving profits. Unfortunately, 80% of the booths on this, in the stall here, on the exhibition here, fall into this space. So this is the marketing-led growth, where all you're doing is building a brand ahead of a product. There's nothing else there. All you're doing is going ahead and telling the bank, I'll acquire customers for you. Bank says, great, cost is yours, revenue is mine. Why should I have a problem? And the last is design experiences for consumers. Now, this is a very different space. Here, what you're doing is you're taking together various services of banks, stitching services into experiences. This is hard to design. This is hard to market. And it is product-led growth. But this is the growth which we miss understanding in the West. The Twitters, the Facebooks, the Googles that we take example of, the Stripes, the Squares that we take example of, are all product-led growth. Hard to design, hard to market. It has low limelight because till it becomes successful, you don't come on the front page of Economic Times. Great profits, great outcomes. And this is a space which is growing up now. There are lots of things that are happening in this space. So let me come to my last slide here to hopefully summarize what I'm talking about. Don't copy Western business ideas in India in the payment space. Indian payments is unique. Please don't copy it. You will definitely get funded, very high chances that you will get funded, but it is very unlikely that you will keep getting repeatedly funded. Because at some point, the investors will also figure out that, look, this model is not translating into profit. Don't copy. Indian payments market is unique in its own ways. Mere distribution of regulated entity products. We are a regulated entity, but mere distribution of regulated entity products, taking a loan of a bank and distributing, saying, I'm going to get customers for you. Taking a mutual fund and distributing, I'm going to get customers for you. Taking a policy and distributing, I'm going to get customers for you, is not going to work. It will lead to a lot of revenue, no profits. Okay? Digital marketing, everybody has the same tools. Please remember. Same big ad tech access, Google, Facebook access is not restricted to anyone. Everybody has access to the same set of tools. That's all nonsense. Doesn't work. Money is in managing mismatches, enabling collaboration, enabling measurement, a lot of stuff there. And finally, develop software for banks or craft experiences for consumers. These are the two spaces. The rest of it is all vanity. Right? Rest of it is all vanity. If you're fond of vanity, great. There's no profit inside it. So that's what I wanted to share with you guys. Thank you. The whole idea here was hopefully to stimulate your minds into thinking that there is money in payments. Thanks.
Ladies and gentlemen, can we give Rajeev a huge round of applause? I think it was really educational, engaging, meaningful, incisive, all at the same time. The simplicity with which he actually explained the entire facet of making profits from payments as a source was simply mind-blowing. It's true that Innovative Payment Solution has been doing awe-inspiring work, and they also got a lovely recognition last evening for which they couldn't come. And the category in which they won is called the Best Bill Payment Solution Award. They won this award last evening at the Global Fintech Award, where we sought nomination from more than 150 organizations and got more than 700 nominations. So I think the winning recognition that they got last evening is a complete testament to their high quality products and services. So I think it's time to recreate their moment of recognition here and to give the award to the Innovative Solutions team. I'd like to call on stage Ms. Ratika from PCI to felicitate and recognize the entire team. And can I call Mr. Rajeev Agrawal, founder and CEO at Innoviti Payment Solutions, and his entire team to come on stage as we recreate this moment of glory for you. So Rajeev and his team, can you all come? A big round of applause, ladies and gentlemen. All right, here is the team, the tribe that makes it possible for them. So a big congratulations to all of you guys. Lovely, awe-inspiring work. And the fact that you won it. Thank you, Latika.